Hello and welcome to this video on the business cycle and unemployment. In this video, we're going to look at what is meant by GDP. We're looking at something called the business cycle and how that affects businesses. And then finally, we're going to have a look at what unemployment means and how that affects businesses as well. So let's start off. In this series of videos, we're going to be talking about how the economy can affect businesses. But what do we mean by the economy? Well, the economy, quite simply, is a system. It's a system that humans have created, that society's created, to turn things like land, labor, tools and money into things that people want to buy. So it's this system through which resources are turned by firms into items that households, you and I, want to buy, is the economic system. And when we're talking about economies, we're normally talking about national boundaries. So we're talking about the UK economy or the Greek economy, for example. So the first thing we need to look at is how do we measure the size of the economy? How do we measure how much this system is producing? Well, we measure it through a statistic called gross domestic product, or GDP. And gross domestic product is the market value of all final goods and services produced within a country in a year. And economists use this concept to measure the size of an economy. So if you try and think about the value of all the cars that are produced, the value of all the cinema tickets that are purchased, the value of all the clothes that are produced, the value of all the food that's produced, the value of all the mobile phones that's produced, and you add together the value of everything that's being produced within a country in a year, you get to that country's GDP, how much that country is producing. And this figure is often estimated by governments, but we do need to bear in mind it's very difficult to know this for certain, and so GDP is always just an estimate. What do you think might be the top 10 countries by GDP, by the value of what their economies produce in the world? Well, if you're interested, here are the answers. Okay, so we've looked at what is made by GDP. Now we need to move on and look at the business cycle. So if we have a look at UK GDP, here it is. What you can see is that GDP tends to go in a bit of a cycle pattern. Some periods we're increasing the value of what is being produced in the economy. Some periods the value of what is being produced in the economy decreases. Some periods at quite a low level, and then sometimes it starts to go up again. And we call this way in which the economy tends to fluctuate as the business cycle. Now here, this is worth, UK GDP is worth approximately £1.5 trillion per year. If we were to have a look for another economy, perhaps Greece, we can see again we have periods where the value of what's being produced by the economy rises. We have quite high periods of output, and then in Greece's case we've had quite a long, slow, long decline in terms of output. But again, we do see a cycle. And these fluctuations in GDP over time we call the business cycle. And there are 4 phases that we need to be aware of: recession, slump, recovery, and boom. And this corresponds to what's happening to GDP, the value of what's being produced at that particular time. So we can here see recession is when GDP falls, slump is when GDP is at a low level, recovery is when GDP starts to rise, boom is when GDP or output is at a high level. So in booms, we'd expect to see high levels of consumer spending. Business is very confident, lots of profit and investment. Here we have a situation where a lot is being produced in the economy. People are also feeling wealthy, so prices and costs tend to rise faster. Unemployment tends to be low because there's a lot of activity going on for businesses. During recessions, we'd expect to see falling levels of consumer spending and people being less confident, therefore lower profits for businesses who will maybe start to cut back on investment. We might see them having spare capacity in terms of production, rising unemployment. In a slump or depression, the bottom of the cycle, we'd expect very weak consumer spending, very low levels of business investment, and some businesses to go insolvent and shut down. When we get back to recovery, things start to get better. Consumers begin to increase their spending again. Businesses feel a little more confident and start to invest again. So how might businesses respond to changes in the business cycle? Well, during periods of recession or slump, from a financial perspective, businesses may be cut back on investment. They're really trying to look after their cash flow and make sure they don't run the risk of going insolvent. What might they do in terms of marketing? Well, they might think about their pricing strategy. They might try and promote more price inelastic products, and by that we mean products where customers are less sensitive to price. Again, we might see them focus maybe perhaps more on their core markets and take less risks expanding into new markets. In terms of the scale of production, they might try and reduce capacity. Possibly they might try and make workers redundant. What about during periods of recovery or growth? Well, from a financial perspective, we might increase investment or try and maximize profit. From a marketing perspective, we might go for more of a price skimming strategy than a penetration strategy. Again, we might look to possibly expand into more markets. Perhaps we might increase capacity of production or maybe hire more workers. Now let's move on and look at unemployment. Now, unemployment refers to people looking for work who cannot find a job. And we normally measure this in two ways. First of all, we look at how many people are claiming unemployment benefits, and we call that the claimant count. However, that might not include everybody. Some people might not include unemployment benefits. So we also look at something called the Labour Force Survey, and that's carried out across many countries by an organisation called the International Labour Organization, and they ring up households or survey households and they ask who living there hasn't got a job, who has sought work in the last 4 weeks and are available to start work in the next 2 weeks. And they use that to calculate the number of unemployed people. Unemployment is really effectively a waste of a resource in an economy and reduces productivity and standards of living. How might unemployment affect businesses? Well, if there's unemployed people, they may not be developing their skills properly. Or if there's too few unemployed workers, there might not be an availability of skilled staff for businesses to use. In terms of demand, high unemployment will probably lead to less demand because people don't have incomes to spend. However, a high unemployment might be good for business if it means that wages are lower and that keeps costs down. The effect really depends on a number of things. First of all, the income elasticity of demand. And what we mean by that is how sensitive is the demand for the business's products to changes in income. So essential items, generally speaking, will still sell even if there's unemployment, but perhaps not essential items, business may struggle to sell those. Also, it might affect, depend on what market they operate in. If it's quite a big global international company, then unemployment might not be as significant than if a company is just based in one particular country. Now, there are 4 different types of unemployment that we should be aware of. The first type of unemployment we call structural unemployment. And this is when people become unemployed because perhaps there's a new technology or a new production method, for example, robotics in the car industry. And when these are introduced, people are made unemployed as a result. It can also happen when a major industry leaves a particular area. So, for example, if you've got an area that's famous for coal mining and the coal mines close and people are left unemployed, we would describe that as being structural unemployment. The government may overcome that by maybe using training schemes or encouraging businesses to move back into affected regions. Second type is called cyclical, and this is linked to the business cycle, where we have recession or slump, and as a result we have high unemployment because there's just no demand in the economy. We would call that cyclical unemployment. Governments can maybe combat that by increasing government spending or maybe cutting taxes or reducing interest rates. The next one is frictional unemployment, and this occurs when people are unemployed because they're moving between jobs. So with the job awaiting them in maybe a couple of weeks' time, but for that couple of weeks they are out of work and count as unemployed, even though this is not really a major problem for most economies and not really one that we'd expect to solve. The last one is seasonal unemployment, and this may be someone who is maybe a ski instructor and they work during the winter but not in the summer. Maybe they're a lifeguard and they work during the summer and not in the winter. And as a result, at different times of the year, they are unemployed. Okay, so what might be the implications for businesses of unemployment in the economy? Well, first of all, there might be a fall in sales. If people's incomes fall as a result of losing their jobs, we'd expect demand for products to fall. Another impact might be reduced labour costs. If there's unemployment in the economy, workers may be willing to work for lower wages, and this will reduce the costs that businesses face and increase their profits. If there's unemployed people in the economy, again, there may be a better availability of workers for firms to choose from. Better workers and lower costs might lead to more competitive products abroad. Often we see that maybe firms might diversify, try and create new products, or perhaps firms might merge, might join other businesses together if they're struggling through low profits in this period of time. We might see firms struggle with excess capacity, so they might have a large-scale business, and because there's a fall in demand, they've got spares capacity, which is costly. Redundancies may occur. They might have to get rid of workers if there's low demand. Now, of course, this will be the opposite if there's actually low unemployment. So we've assumed here when we're talking about this that there's been high unemployment. Now, what exactly a firm might do about this really depends on lots of factors. So how big the firm is, its financial strength, the nature of its products. So really in this situation, you'd have to analyze the business's circumstances. It's really all about the context as to whether the business is going to be a winner or a loser. So in this video, we've looked at what is meant by GDP. We've looked at the different stages of the business cycle, how that might affect businesses. And then lastly, we've looked at unemployment and how that might affect businesses. That's it. Thanks very much for listening.